Welcome to the Value Investor Chatter podcast. My name is Becco and my co-host Hari.
Hello.
We're going to talk about what's going down right now with Silicon Valley Bank. We're going to talk about, it's a moving target right now, and it's actively developing. So right now we are recording this podcast on March 12th. This is Sunday afternoon here in the U.S. There are a lot of talks about what's going to happen. So we thought we'd give you our perspective, just share our perspective on what's happening from us as a value investor perspective, and then also transition into something more tangible. And that is, what are some things that you should look at when you're analyzing a bank stock or any company that has as a business that is lending out their balance sheet, basically. And so we'll talk about those two things. So before we begin, Hari, give us a quick disclaimer and let's get
Yep.
started.
This is the Value Investor Chatter podcast. We are a podcast that helps you grow your wealth and understand financial markets. We are not financial advisors. We don't know your specific financial situation, so please consult with the appropriate advisor before making any investment or tax decisions.
Great. Again, like I mentioned, this is a moving target. So let's, Hari, could you tell us what transpired over the last 48 hours, let's say?
Yeah. So for those of you who are, like Becco said, we're still don't know all the answers to what's going on. But on March 8th, the bank, SVB's CEO reported that they had to sell some of their short-term bonds that they were holding at a loss, the most liquid bonds at a loss, in order to have enough liquidity in their bank account to handle deposits, money outflowing from the bank. So when this was heard by the depositors and investment community as a serious problem for the bank, and so a lot of venture capital firms said to have you told their investor
Portfolio
portfolio companies, thank you, to withdraw their funds and move them to other banks. And so what happened was it created an old-fashioned bank run. So essentially $42 billion of cash was taken out of Silicon Valley Bank or withdrawn from Silicon Valley Bank on Thursday, the 9th. And as a result of this, the FDIC stepped in on the 10th, Friday, to take over the bank, and they actually locked people out of their accounts. So my company actually has an account on Silicon Valley Bank. We were trying to wire money out on the 10th, the morning of the 10th, and it got stuck in a pending state because the FDIC took over the bank, prevented any transactions and account access during that time. And then what happened after that is the FDIC issued a statement saying that depositors will be receiving, the bank will open on Monday, $250,000, which is the cap of insurance that a bank is offered by the FDIC, will be available. And that later in the week, they will pay out a special dividend on the 30 to 50% range of the remaining balance on that deposit. So nobody actually knows. They haven't said how much that second payment will be. But there are some companies that have, balances, that are under the $250,000 threshold, will get all of their money back. If you have more than that, some people I've heard have, hundreds of millions of dollars in Silicon Valley Bank will get 250,000 also, and then they will sell off bank assets or try to find a buyer, and that is what is ongoing right now, as we speak.
It's a very dynamic situation, and to be honest, it's a very frightening situation for a lot of people. And I mean, I think this is a moving target. My guess is that it'll be resolved one way or the other, and some people will be hurt more than others. Some people will be probably fine. What I would like to transition now into is, instead of trying to speculate on what will happen, I think what we could do is actually look at some of the things that you should look at when you're analyzing a bank stock. or it could
Yep.
be an insurance stock, or it could be any businesses that are using their balance sheet to conduct their business. Some of these principles will apply. So I thought this could be a good opportunity to actually talk about some of those things. So
Yeah.
let's start there. What
So
is on your list, Hari?
yeah, so I will just add to this before we get into that discussion that SVB as an entity, as a bank, was publicly traded. It will likely not um, survive whatever happens this weekend. The FDIC stepped in. They have branches all over the world, and each government is also stepping in to kind of limit what happens. But the thing about a bank is it's not an isolated entity. It has deals with other banks. It makes loans. The cash that it has is not actually cash, right? It's dependent on people not withdrawing all at once. And so why SVB is unique in this situation, to get back to the original question, is SVB catered, Silicon Valley Bank is located in Santa Clara, California, in the heart of Silicon Valley, and they cater to startups. So a lot of venture capitalists use that bank, host their own money there, and then the startups, they encourage them to use that bank because of some transaction fees and other things. So here is really what happened, and this is why what you should look at when you use our checklist.
By the way,
Um,
I just want to point out one more thing. I've
yep.
never worked for a company that didn't bank with Silicon Valley Bank. So it just goes to show that it's pretty deep. Is very much synonymous with the Silicon Valley. They call it now the innovation economy, but this whole, startup ecosystem, they're one of the backbones of this whole ecosystem. Anyway, back to you, Hari.
Yeah. So Silicon Valley Bank's biggest problem right now is that was venture money in the last 10 years when we had zero interest rates, for a long time. Venture money was flowing in freely. Um, and as the interest rates started rising, venture money started disappearing because people were taking their money out of the venture space and putting it into bonds and other things. So what ended up happening is Silicon Valley Bank had a significant portion of their assets in these, startup space. So when those start to disappear, their deposits disappear, and now they have less liquidity and less, things because they relied on those deposits to be, to make loans and do other things. So the other thing about it was rising interest rates also screwed them in terms of they lost $1.8 billion and then announced that they have to sell shares in the company to make up for this loss, right? So I have not read their annual report, um, and I'm not an expert on financial, companies, but what I would heavily look at is if Silicon Valley Bank, and I'm sure when you read their annual report, will say they cater to the startup world. If they put all their eggs in the startup world basket, and then the startup world starts to dry up, it's not inconceivable that this could happen, right? Now the question is, could you read that annual report, that was issued 3 months ago and foresee that, right? Um, that's one of the things that, when I looked at the banking industry, the company that I had is considered probably the best run bank in the world, which was called Axos Bank. They have the highest return on equity of any bank in the US, but they're still very small and growing. Um, what I would do is I would compare that annual report run by a CEO who I admire very much, Greg Garabans, and see, I would compare them to how Silicon Valley Bank runs. And what you would see is Axos will report many quarters where they have no defaults on any of their loans, which is unheard of in most companies will report a percentage. Axos will have, because they use technology to set up their loans and other things, right? So what you really care about with a company like Silicon Valley Bank is, deposits are the lifeblood of the bank. That's how they make, they get money to then loan it out. If that dries up, right? JP Morgan, Bank of America, your local regional bank don't have that dependency, right? They could be doing things that are like in 2008 where they put a lot of their money in these high risk mortgage loans and then mortgage backed securities that caused the financial collapse. Um, but I would be very careful and look, through that and see what is Silicon Valley Bank doing? Well, it was what they catered to that caused this problem.
Yeah, what they catered to is one. I think the second thing that you mentioned there is the interest rate rise. And I think the thing that just blew my mind was that the mark to market, I mean, the accounting rule around accounting rule around the reporting requirement for what's in their balance sheet, especially the treasuries that they buy, they're not mark to market, and so they can hold. They might have purchased $100 million of bond, and they might have th- if they hold it to maturity, they can just mark it at the purchase price and never have to mark it down. And so that was where the discrepancy was. And I see some people are posting that the delta between the purchase price, which is what's on the book of all these banks, to the actual value of those treasury bills today, the difference is like something like 200 or 500 or 600 billion dollars in value. That's another thing that you have to look at. So,
Yep.
um, let's transition to the question that we should really pursue, which is, okay, so that you look at, who are they catering to? Okay, their customer. You could look at, what is the loss ratio. What are some other things that we should be looking at when you want to get into a bank?
Yeah, I mean, I would look at, just understanding what, most banks are not catering to a particular clientele or a particular, industry or anything like that, but there are a few like that. And those are the ones that are going to be, I would be the most careful about, because if they're heavily dependent on the industry that they're in, that creates its own headache, own set of, situations that you have to watch out for, right? The other thing is you have to be careful about it when banks generally make more money in a higher interest rate environment because they are able to offer the loan, get a percent, a 7%, you know, APR on your mortgage will give them a higher, amount of money, but they may have fewer loans that they give out, right? But the big challenge is when they transition from a low interest rate environment to a high interest rate environment, the impact on that can be what you just talked about, right? They had a they had uh they had a paper loss. They didn't actually have a loss in this scenario, but they had to get funds, quickly. And in order to do that, they had to go and they talked about selling shares in the bank. Well, venture capitalists, which this is actually a felony to say that there's a bank run. They triggered this bank run by pulling their money out, and then that's when the FDIC stepped in, right? So, if you have a group of people who are very skittish, like venture capitalists and their portfolio companies, this scenario could happen, right? So I don't know if it's going to be, you'll find other things where this could apply, but it's another thing to add to your list of checks if you're looking at a bank, right?
Mhm. Yeah, that's certainly one of them. And it looks like, Silicon Valley Bank is a very regional player. The one that you looked at, Hari, I think Axis Bank, it's also a very regional players. How
Yeah.
do you think about the regional players versus big players? Why should somebody like invest in a regional player? Does it even make sense? What would be some of the things that you would look at specifically for regional banks versus like a big, bulge bracket banks like, JP Morgan and Bank of America, et cetera?
Yeah. So as you get larger into the amount of deposits, the Fed actually adds more and more restrictions on how a bank operates. And what you'll see is a lot of these companies will actually try to avoid going across the threshold because it's a huge regulatory expense for them to go above it. Um, so when you talk about Bank of America and JP Morgan, they have the highest restrictions in place. That means they have to keep more cash available for any kind of bank run than, say, a Silicon Valley Bank. Silicon Valley Bank was under that threshold, so they're not in the too big to fail category. So if this were to happen to a JP Morgan or Bank of America, I would imagine that a bailout would be, one of the things that would be talked about more. Since they're a regional player, they have they're actually able to grow faster because they have less restrictions. They don't have to keep as much cash. But you have to also watch out if they write too many bad loans, that they can't recover, that's lost to to the bank's equity. If if there's a severe recession, they have fewer loans that they can issue. So they start losing, money in that, in that regard.
Mhm. Yep, that makes sense. And, one of the reasons why you and I looked into this company, right, Access Bank a few years ago,
Yep.
um, and they were primarily writing loans for commercial real estate. Is that right?
They were writing primarily loans for commercial businesses. They weren't necessarily always real
Real
estate
estate,
loans.
commercial real estate. So some of the banks are obviously, like, focused on a particular type of loan, right? Like commercial real
Right.
estate, residential real estate,
Yeah,
et
exactly.
cetera, right?
So they'll all have specialties, but I mean, if think about it, if you had have found a bank that's catered to oil and gas companies, right? And they all have a bunch of deposits. Oil and gas is at $100 a barrel. Everybody's making money. The bank actually has more deposits, right? Then oil and gas tanks, and the banks who have a lot of loans and things like that may lose a lot of their asset base, right? So
Mhm.
that's where you would have to look in and see, are they exposed to a certain industry that could cause this?
Yeah, be a collateral damage, in an industry. What do you just I suppose let's wrap this up with one last question. This is a short one. One last question, which is there are companies like banks, for example. This is something that I mentioned earlier in the podcast. These are companies that operate out of their balance sheet. They're in the business of lending out their balance sheet for
Yep.
other people. Right? They're effectively sort of creating money out of thin air using their balance sheet. There are other companies that do the same thing, like insurance companies, for example. How would you think about companies that are sort of similar in a similar vein where, they're using the balance sheet to run their business? How would you think about, is there any differences should people look at compared to, bank versus insurance company?
Yeah, so it's effectively the same problem. Like, imagine if you had um an insurance business that was running in the Midwest, right? And you provided hurricane insurance, right? Well, you probably wouldn't get very much for your premiums, but you probably have almost no payouts either, right? So compare that to running that same business in Florida, right? Where, a hurricane may run into the hundreds of millions of billions of dollars of damage that an insurer would have to be on the hook for, right? So you would want to see, what is the exposure that that insurance company has, and what risk levels are they offering, right? So especially with things like, catastrophic events that are rare, right? Like a terrorist attack or you know, a, um, a, a natural disaster or something like that, right? Insurance companies have risk, and then they have reinsurance, which provides a stopgap above a certain threshold. The insurance company doesn't actually have to pay, right? It goes out to the reinsurer, right? And so the insurance company will have a limited thing that they will have to pay out of their equity. And that means that if they pay it out of their equity, that means you as the investor lose all of that equity as soon as it's paid out, right?
Yep.
So you have to be real careful and understand those risks, which is why I don't typically buy insurance companies, because I don't necessarily understand that business.
Yep. It's yeah. One example that comes to mind when you talked about Florida insurance was this Universal
Yep.
Insurance,
Universal Holdings. Yeah.
Universal Holdings. They were, I
Yeah.
mean, on paper they looked very attractive, I have to say. And I
Yeah.
looked into them, but
Yep.
precisely for this reason, they were insuring primarily Florida. I think they came out of Florida and they were insuring residential homes or something like that.
Yep.
And obviously, there's a tremendous amount of risk when it comes to like hurricanes and flooding and things like that. And when I looked at them, I think we looked at it together back in like 2017 or something like that.
Yep.
There were string of these catastrophic events that would come every summer, and they
Yep.
were just getting hit really hard. So I was like, this is not for me.
Well, and ironically, I don't actually know what happened to them, but our thesis was they actually had an upper limit to the amount of damage they could take. because the state of Florida was their reinsurer. So, but I think that they still, because they kept taking those hits, I think it just affected their balance sheet.
Mhm.
To the point where I mean, the last time I looked, they were trading, at 75% of less than what you
Mhm.
and I were looking at it the last time. So,
Yeah, it's interesting. Just one more comment on this. It's funny because you don't really think about this is veering off a little bit on a tangent, but you don't really think about insurance as, sort of this kind of sort of the main part, but it is what undergirds a lot of these industries, like shipping, for example. If you want to ship anything back and forth, if you don't have insurance coverage, like we would not be able to get the goods that we do at the price point that we want. Same thing
yeah.
with home insurance, same thing with commercial real estate, etc. The risk that the Florida homes is under, that's a real problem. There's another thing happening in California with, earthquake insurance, uh, uh, wildfire insurance, all these things. It sort of undergirds the entire ecosystem that sits on top of that insurance umbrella. And if that
Mhm.
falls apart, you're talking about lots of industries that work on top of that, basically getting rug pulled. So, um,
Yeah, you what I mean, just to give you, like, in Texas, there is, uh no commercial company gives you flood insurance, right? They have hurricane insurance, which is covered by your homeowners, which is wind damage. But if you have flooding, the water rising kind of damage is actually covered by the federal government provides flood insurance. So this goes to show you that the federal government has a much larger balance sheet that they can, pay out of. Not that I necessarily agree with that, from a taxpayer's perspective, right? Because a lot of that is they can insure people in, like, say, Galveston, Texas, where beachfront homes that go for $4 million are getting fully insured, because of on my dime, right? So anyway, the whole point of that is to say, like, you're these things are all interconnected, right? The big risk with Silicon Valley Bank, right? Obviously, if you're a depositor, like my company is, there's a risk that you may not get recover much of your funds. But the bigger problem, I would say, is um, from an is think about all of the companies that are impacted where they can't pay their employees, right? And then their employees, you know, are suddenly, have unemployed. The same problem is it's going to have ripple effects throughout the economy, right? Because those companies are no longer paying for contracts for, services or other things, because suddenly went under, right? So it has a ripple impact, and we have to see what the final impact is going
yeah,
to end
definitely.
up
The
being.
ripple effect is the secondary and tertiary effect of this is going to be, it's going to be very scary to me. I mean, it is going to stop. It is going to actually do some good in terms of maybe reducing that inflation that we all wanted to see. But I mean,
Yeah,
it's gonna be very scary to see. We'll see what happens. Things are very moving very very quickly. So anyway, so that was a quick kind of an emergency podcast to talk about it. I hope you guys got something out of it. I think it's interesting to look at some of these companies that, again, are operating out of their balance sheet. Some things to look at, like we talked about today, um, regional or industry specific risk. We talked about, loss ratios. We talked about, differences between insurance companies versus banks. So hopefully some of those points were helpful to you. All right. Definitely check us out on valueinvestor.org. We got a lot of free resources there. And if you enjoyed this episode, please like and subscribe and leave us a comment. And we'll catch you guys in the next episode.
thanks.
Thanks.